Joining me now is Aswath Damodaran, professor of finance at the NYU Stern School of Business. Aswath, welcome. So it sounds like you're not in the IPO.
I'm not in the ARM IPO, but I think that, this is not 2021. In 2021, I wouldn't have been surprised if ARM had gone for $100 billion.
Right.
There's hype, but there is a reality here, which is this is a true AI play, and it's a money-making company. It's already a company that's figured out a way to make money. So I think there is a plausible path to today's stock price. And as I said, my only red flag here, one reason I would hold back, is I'm not sure I want to touch anything that SoftBank has already touched. One thing we've learned over the last 3 or 4 years is SoftBank doesn't have a sure touch when it comes to building businesses. Mm-hmm. So I would want to avoid whatever SoftBank tells me to buy.
Although maybe you could because they're still in I was going to say you can make the argument now, but they are still in control. They're only floating 9% here.
Right. I think they're still in control, and that might be the reason I hold back, is maybe if they let ARM be run by the people who built the company up, I'd have more confidence in the company. But Masa Son should not be the spokesperson for the company. It should be somebody from within the company.
Yeah, and we did hear from the CEO earlier today. Can expect to hear more from him going forward. Let me ask you about Instacart, because we're going to go there next. Valuation $9 billion, down from $39 billion. And again, in 2021, this could have been a $50 billion or more listing. So, you might say, well, its best growth days are behind it. Well, that was going to happen anyway. So did you want to get in at a $50 billion valuation or get in at 9?
I think the reality is online grocery retail can never be like online retail in other spaces. You're never going to get 100% of grocery retail, or even, I think you'd be lucky to hit more than 20% being online. So that kind of puts a ceiling on how much growth you can get for an online grocery intermediary. And the grocery business is not a very profitable business. There's not a lot of fat to share here. So it was always a company which was bounded. In 2021, people forgot those bounds. In 2023, I'm glad to see that they're recognizing those bounds. In fact, when I look at the pricing at $9 billion, they're building in the presumption that Instacart will actually lose market share of the online grocery retail business, and that its stake will drop, which I think is realistic. And I'm glad to see reality win out here.
Yeah. Do you think, just to back up for a second, that this is actually a much better IPO environment for the broad public, or do you think IPOs in general are still something people should be really wary of?
I think it is much healthier, because I think people are asking the right business questions rather than pricing questions. Pricing questions are, what will other people pay for this?
Right.
I think people are asking decent questions about businesses, and I think that's always good, because I think we need companies to be put on notice that they need to build business models.
Speaking of, what businesses should be worth, what do you do with media? Your analogy to the music industry doesn't calm my nerves.
Yeah. I think there's a lot of existential dread in movie and broadcasting companies now, because you can see what streaming did to the music business. It devastated it. The collective revenues from music dropped by 40% between 1998 and 2015. It's come back a little, but the business has been remade. It's a very different business with the status quo pretty much gone. So if you're a movie or a broadcasting company, you're wondering, is that going to happen to us? I think the movie and broadcasting businesses are more resilient than the music business. But that said, there are lessons from the music business that might apply here. The status quo is going to get challenged. It already is. I think part of the reason you saw the meltdown in Disney's market cap over the last year is, in addition to all of its company-specific problems, people are looking at the future and saying, I don't know how this business will evolve, with streaming being the dominant way in which content gets out to consumers like you and I.
Right. Studios imploded. Only a handful are left. 1% of musicians are 90% of streams, 60% of revenue. Personalities are bigger than. I guess I got to be Taylor Swift, Aswath, or that's what
exactly.
That's what it's going to take in the next iteration to come here. So I remember when we talked a little while ago, and Netflix was the only of the kind of Megacap Tech stocks you were really bearish on, and this absolutely fits with kind of your warning there for some time. What do you do with the rest of Megacap Tech now? What would you do with NVIDIA? It's only at 35 times forward earnings.
No, people ask me that all the time, because I have quite a few of those big tech companies still in my portfolio. And I tell them the truth, which is, if you ask me whether I would buy them at today's prices, my answer is no. But I got lucky enough to buy them at much lower prices. Mm-hmm. And it tells you that how we treat stocks that are already in our portfolio differently, even though in theory we should not, than stocks that we haven't bought yet. So at today's prices, you're paying premium prices for all of these companies. They're all great companies. Let's put that on the table. But you're paying for these companies to continue to be great, and that's often not a great investing bet because great can become just very good, and that's a negative surprise.